Hi, everyone. Thank you so much for joining our webinar. I think a few people are still joining, so we'll give everyone maybe another 30 seconds for everyone to join. But I have to say it's great to see so many participants here to join our webinar and to hear about the ABGF. So for a bit of context while we wait for everyone to join, we are the Australian Business Growth Fund, and we are running this webinar for companies and advisors and potentially other investors so that you can see how ABGF operates and essentially how we invest in businesses. Now, if you've previously joined one of our other webinars, this one will be slightly different, as this is the first one that will be focused on what it looks like to partner with ABGF. So essentially explaining what happens after the deal is done. So essentially you will hear a couple of case studies from myself and my colleague Jack, and we'll give you some real life examples about what we do post-investment to drive business growth and to create long-term value. So I might just move on to the next slide. I do know a couple of people are still joining, but I'll just walk through the agenda. So first up, we will have an overview of who ABGF is, just for those who don't know who we are. Secondly, we'll give you an overview of what is growth capital and how it can help you retain control of your business whilst you pursue your growth opportunities. Thirdly, we'll then go through what it looks like to partner with us and how it can set you up for success. So this will really cover how ABGF can strategically support SMEs with our expertise that we can bring to the table and how we support them, which is really beyond more than just capital. Fourthly, we'll go through the real life case studies. And lastly, we will go through Q&A, which is your chance to ask sort of your burning questions. Now, we do have a Q&A chat function, so throughout the presentation, feel free to pop your questions into that chat function, and we can address those towards the end of the webinar. So firstly, just to give a bit of an overview of the team and who is speaking today. First up, we have Anthony Healy. He is our founding CEO and managing director. So Anthony previously worked at NAB as Chief Customer Officer. He has also held a variety of roles in the banking industry, from being CEO of Bank of New Zealand to being head of the business bank at ANZ. You'll also hear from my colleague, Frederick Charette. Now, Fred is the head of portfolio and talent. Fred also sits on some of the boards of our investments, and his focus is around portfolio management and leading the sort of people and management part of our DD streams. Now, Fred has a background of working at sort of prior investment houses, and he's also a long-time consultant at McKinsey. You'll also hear from my colleague, Jack Lynn. So Jack is an investment director in the team. Jack works across the whole spectrum of the deal from start to finish. So starting with doing work in origination, all the way to structuring and negotiating the deal, taking the deal through due diligence, and then also sits on boards of our portfolio companies. Now, Jack has worked in PE for a number of years, including at a New York-based PE fund for 10 years there. Then you also hear from myself, Manpreet Soul. So I'm an investment manager in the team, and like Jack, I sort of sit across the whole investment horizon, and I myself sit on a couple of our portfolio boards as an observer. So prior to ABGF, I worked in investment banking, and I was also a corporate lawyer before that. And lastly, you'll hear from my colleague, Tim Hayden, who is our origination director, and his focus is bringing new deals into ABGF. Prior to ABGF, he worked at Barclays in the leverage finance team. So that's an overview of the team and what the webinar is going to look like today. I will now hand over to Anthony, who will give an overview of what ABGF is. Thanks, Anthony.
Thanks, Manpreet, and good morning, everyone. Thanks for joining us. For those who aren't familiar with who we are and how we're set up, the Australian Business Growth Fund was established in late 2020. We were established to address a gap in the market for long-term patient growth capital for founders, for SMEs, for family-owned businesses. It's a public-private partnership, and the shareholders you can see at the bottom of the slide are the major banks and the Australian government. We raised $540 million of capital from those investors. And I should say, whilst they are shareholders in the fund and they have representatives on our board, all of our investment decisions are made independent of our shareholders and obviously made on commercial terms. I chair the investment committee, and it's made up of the investment team within ABGF. We were set up, as I said, to deliver patient, long-term and always minority growth capital for SMEs. The purpose is, of course, to meet that gap, to help drive economic growth and generate jobs. Obviously, they are of interest and import to the government as a shareholder, but also to the major banks, and to support Australia's entrepreneurial ecosystem and to back founders to develop, to innovate, develop new product, and obviously to grow their businesses. Thanks, Manpreet. So where we sit in terms of the market and for capital, we sort of sit in between venture capital and larger buyout funds. So we write checks between 5 and 15 million, but we can do follow-on up to 30 million of capital. We are minority investors, and as a minority, obviously, we can't force exit, so our time horizon is typically longer than a buyout fund. In the venture capital space, obviously, there's a lot of venture capital funds in Australia. They typically write smaller checks. They're often minority, and their time horizons tend to be similar to ours. And it's a pretty strong and growing ecosystem of VC funds in the country. At the other end of the market, there's the large, and you will have heard of them, but the large buyout funds like Blackstone and TPG and BGH and others, that they typically buy out transactions. So they take a controlling interest in the business, majority control, and they write much larger check sizes than we do. But in this gap in the middle, where founders are looking for growth capital or for secondary capital or capital off the table, where the check size is smaller, the businesses are smaller, and where founders quite reasonably want to retain control and therefore participate in more of the upside in the growth of their business in the future, there aren't a lot of funds dedicated to that space. And in fact, we're probably the only one of our kind in the market with a specific minority mandate with the check size we do. You'll hear later about all of the work we do with the founders once we've invested, but that gives you a sense of where we sit in the market and the sort of businesses that we target. I don't think it says it there, but it's typically businesses turning over between 10 and 100 million. Thanks, Manpreet. I'm now handing, I think, to Tim, our head of origination.
Right, thanks, Anthony. I'll just provide in the next couple of slides a quick overview of the typical profile of businesses that we look at, and also our investment approach itself. For some of you, this may be a recap, so I'll work quickly through this as to leave plenty of time to talk to the main event and the main aspect of where most of our work is done is post investment itself. So some of the key kind of criteria initially we look for in businesses is Australian headquartered. Now, this doesn't necessarily mean that the business cannot have a significant portion of their sales offshore or operations offshore. A number of our portfolio companies sell a number of their products and services offshore. In terms of where we operate in the market, as Anthony was highlighting, we do have a cap of 100 million in terms of revenue. And as Anthony mentioned, typical metrics from a financial perspective would be around 10 to 100 million in revenue. From a profitability perspective, we do look for a track record of profitability. There's no minimum profitability number that we look at, but thinking about our check size and minority investment approach, it's typically sort of minimum EBITDA of around 2 million. Now that can differ depending on the nature of the revenue base, whether it's a software as a services business or a more typical manufacturing or services business model. The other thing we look for in opportunities is a unique value proposition. Now, this doesn't necessarily mean the business has to have a one-of-a-kind product and be the only operator within their market. What we're really looking for is a business that offers a compelling value proposition, has strong relationships with their customer base, and longevity within their model. In terms of significant growth potential, we're a commercially focused investor. We look for businesses that do have a clear pathway to scaling their business operations. And that growth can come from a number of means, whether it's expansion into new markets, interstate or international, launching new products or enhancing existing products, or a range of organic growth initiatives, or M&A itself. And the team will talk through a number of case studies of how this has played out practically later in the session. In terms of sectors themselves that we look at, there's a couple highlighted at the bottom of the page, which I won't go through specifically. But really, some of the key sectors that we're looking and targeting at the moment in areas like defense, mining services, IT services, and more broadly, businesses with professional services, especially businesses with the ability to leverage technology to enhance their service model. Healthcare is another area we've focused and looked at in the past. In-home care is an interesting space that we're looking at. But more generally, we're a sector agnostic fund that will look at all opportunities that are able to identify a unique value proposition and significant growth potential. Now, the last point I'd just make is it's really key and critical for us, and this will come out later in the session, is it's businesses that have founders that are keen for partnership and us working alongside them to build a growth strategy as opposed to just the capital itself. So on the next slide, I'll just quickly highlight some of the key sort of investment approach and parameters that we operate by. So we're a minority equity-only fund. So that's leaving the majority founders in control of the business. Now, this is often sometimes a tightly held family-owned business, or it may be a mix of shareholders, but normally sort of not in excess of 10 shareholders is typical for us. The investment itself is $5 to $15 million, as Anthony mentioned before. Now, we do offer the ability to go up to $30 million whilst remaining in a minority position if there's further M&A or growth initiatives that are opportunities later on in the stage of our investment. This money can be used to fund those growth initiatives, or it can be for secondary sell down where shareholders may just want to take a little bit of money off the table to realize some of their hard-earned money that often is sort of still sitting within the business. We're patient in our approach. We work collaboratively with the founders of businesses to identify the most appropriate exit timeline for the owners of the business. So we can invest up to 10 years. Typical horizon for us would be in somewhere between 4 to 7 years as an exit horizon. And then on the final point around active investment and governance approach, I won't touch on that because there'll be plenty to talk through with that. And I'll hand over now to my colleague, Fred, to talk through how we add value post investment.
Thank you, Tim. So I think the link I want to highlight is the fact that as a minority investor, we don't come with a cookie cutter approach to the way we interact with our portfolio companies. Our approach is very, very tailored to the level of maturity of each company. So we want to be a strategic partner. We want to add value. We're not coming in to tell anyone what to do. However, the level of our involvement can vary greatly from, in one situation, literally putting in place everything from hiring a CEO, creating a board, appointing a chair, putting KPIs in place, revamping the financial reporting. So that's at one extreme. And at the other extreme, it would be joining an existing board with an existing chair with a very well-formed strategy with excellent reporting, where we become more of a value-added voice with a diverse perspective on the strategy of the business. And our involvement is much more limited in that case. So that's the point around tailoring. The second one is the one thing that is common across all our portfolio companies is that we do bring a kind of very structured and constant rhythm of interaction in terms of monthly board meetings and annual offsites or workshops to make sure everyone is aligned on the strategy of the company. So that rhythm is what enables us to keep a constant flow of communication and also make sure we can adapt quickly as the environment changes. And when I say the environment changes, it can be domestically, it can be changes in regulation, it can be, competitive actions, but it can also be, tariffs, what's happening in the US, depending on whether the company exports or imports with or trades with the US. Now, what's the benefit of this regular cadence? The benefit is it brings a certain cadence to decision making, where you're not rushed, you're not making panic decisions. You're actually always very thoughtful, and you can see things coming, and you can bring facts to bear to those decisions as opposed to operating on the basis of intuition. So that's what we hope to bring in terms of our active involvement. Now, the way we think about driving growth, let me go to the next slide. So how do we assist with value creation? So it's a three-part framework. Obviously, I just can't escape my McKinsey heritage, and I'm talking 3 bullet points. The first thing is obviously to align the board and the shareholders around the strategy. But it's much more than just the strategy. The strategy itself is how does the board make decisions? It's the infrastructure surrounding the board and the shareholders, meaning do we have the right capital structure? Do we have the right policies? Are we managing our risks properly? And is it clear what the board is asking the CEO to deliver on and the process by which the CEO is going to get feedback? The latter point is quite important because many founders are used to basically call all the shots and, let's say, not really getting the real feedback from the people surrounding them. In many situations we've observed, and what we've found is the very best founders and CEOs that we work with, they're keen learners, they want to become better leaders, and they're avid for feedback. So it is definitely something we look at during the diligence process is the relationship going to work between us and the founder, because we're going to be, in many situations, avid to give feedback, but if there's no openness to receive it, it's not going to make for a successful partnership. So that's the first thing, is what we call the strategic oversight pillar, which is all about making sure we're all aligned on how we're going to make decisions and what the strategy is. The next thing, we call it management excellence, but it's all about execution. And execution is not trivial. It has a leadership and people component, and it has a very strong finance and operations component. Now, for anyone who's operated in a large organization, these things are very well known. It's kind of, bread and butter of large organizations. But for small organizations, oftentimes they may be very strong on one or two of these dimensions and quite weak on others. And a very good example of that is many of the companies, when we ask them, how successful are you at recruiting? The answer is it's a throw of the dice. It's 50-50. For every good hire, we have one bad one. And when you look historically at the number of hires they've made, you can actually verify that. So what we aim to bring is a bit more discipline, for example, around recruiting, more discipline around reporting, around cash flow forecasting, when it's not already in place within the company. Because this is the condition to be able to execute on the strategy, right? If you don't have good finance, good KPIs, good systems, obviously good people, good leaders, you're not going to be able to deliver or execute on any strategy. Now, the last one is the the pillar of growth initiatives, which is what it's all about, and it's what our mission is support the growth. Now, growth itself is not one thing. We think of it as three things. The classical one is the first two elements, which is you have your organic growth, and it can be domestic or international. It can be an international expansion, but it's all something you control. You're very deliberate about, and it involves basically either expanding your the channels through which you sell, or expanding the product range, or expanding the countries where you sell. So that's all about the sales and marketing excellence, and it's organic growth. However, there's always a balance in many cases between should we do that ourselves, or should we partner with someone or acquire someone, which is where the M&A and partnership comes in. And finally, the last element is market agility, because stuff happens, and we have many illustrations, and Jack will talk to it in a moment, where competitors go into administration, and suddenly you have an opportunity to buy their clients or their assets, or you might have a new entrant in your market, and then you need to react. You need to be able to react quickly in terms of pricing or securing existing customers to avoid losing customers. So that's where the market agility and the ability to pivot quickly is quite important from a growth standpoint. So this is what considered, let's say, the way we approach the value creation. Now, it was all right, Manpreet. You can go to the next slide. So I'll give two examples, one around governance and one around our leadership recruiting support. So on the first one, a lot of companies don't necessarily have guidelines around things that are quite essential in today's world. Let's say cybersecurity policies and guidelines, templates for building business cases for large investments. They don't have necessarily an incentive program for their employees or an equity participation program. So for all these things, rather than reinvent the wheel, we have all the templates, all the step-by-step of how do you put that in place, who do you need to consult, if you need to retain your own kind of legal advice, who you should go to. We have some preferential deals with some external providers around legal, finance, marketing, data, AI, and search firms, obviously, for the recruiting side of things, which is the second thing where we provide a lot of support. So even across our first 13 investments, we facilitated 27 hires across different levels in the organization, mostly senior levels, right? So we've appointed 4 CEOs in companies where the founder didn't want to be the CEO and wanted to have a different role within the business or be on the board. Multiple CFOs, a great variety of functional heads, and even lower down, like graphic designers and financial analysts, financial controllers in the finance team. So on all of that, we'd be like basically drafting the job description, sending an RFP to search firms or agencies to recruit, proposing a step-by-step process for the selection, like when do you interview, when do you test, what kind of case study should you run if you're hiring, for example, a finance person. We have all of this at the ready, at the disposition of the portfolio companies we support. So those are examples of the 2 buckets. Now, this is our current portfolio. And the ones I've highlighted, Manpreet will talk first about Modra, especially around management excellence and execution. And then Jack will, in a second, talk about CLS and what we've done in terms of growth initiatives, and especially around the 3 different pillars of organic growth and market agility. Before we go to Manpreet, the one thing I want to highlight on this slide is the variety of industries that we cover. I think Tim mentioned it, but we're pretty sector agnostic, right? If it fits within the broad mandate of ABGF, which is basically at the one end, we don't do hard assets. We don't do real estate and infrastructure and mining. And at the other end, we don't do financial services as the banks are our shareholders, but pretty much anything in between that goes from B2B industrial manufacturing, all the way down to, online e-commerce and healthcare. We basically cover the gamut, and we cover in all the states in Australia. I mean, at the moment, I think there's only a few. We're still looking for our first investment in South Australia, I think, and maybe in the north, but we're already in WA, Victoria, Queensland, and New South Wales, obviously. So without further ado, I'll pass it to Manpreet to give us some examples, the story of what we've done at Madra to basically put in place the governance, the strategic oversight, and the management, improving management excellence and execution at Madra.
Thanks for that, Fred. Today I will be talking about Madra Technology. So Madra is a family-run business based out in Warragul, Victoria. Whilst it is based in sort of a regional town in Victoria, it has sort of enormous reach. The carpet industry is a global industry, and Madra has served sort of 200 customers across 35 countries. Now, the founder, Tim, has been incredible in building the business from essentially nothing about 20, 30 years ago to where it is today. And he has created a world first in terms of technology for carpet manufacturing. Essentially, his technology automates a specific section of carpet manufacturing so that it helps manufacturers save on both waste and labour costs, as well as improving safety. So since our investment about 12 months ago, we have been doing a fair bit of work on this particular investment to get it to where it is today. And there are three key buckets that we have covered to date. One being governance, two being people, and three being growth. So in terms of governance, we have put a board in place, which previously wasn't in place at Madra, given it was a sort of founder-owned business with no external shareholders. So having that board in place now, we have also hired an independent chair, which is pretty common across our portfolio. Given we're a minority investor and we are here to partner with founders, we usually find it quite helpful to bring in an independent chair that essentially will sit on the board and provide that independent view at a board level to ensure that the founder and us as investors are able to work together on opportunities whilst bringing in this independent person who usually has either this sector knowledge or has done something very similar before in another business. So in addition to this, we have also set up very solid board reporting. Again, given the business never had a board in place before, it's really gone from 0 to 100 in terms of board reporting. And this has been extremely high quality, and we've been extremely impressed with the team and where we've gotten them to date. In addition, we have also had ABGF's CFO advisor be involved in the business, sort of on a 1 to 2 days per week basis initially. Now, sort of upfront, Madra had a finance function, but it was, I guess, always treading water. And I think we find that is pretty common amongst a lot of the businesses that we see. Usually the focus in the business is on, of course, getting those customers, getting those sales through. But there's generally what we find is there's not as much focus on the financial reporting. And we find that financial reporting is really critical to making good business decisions, to know how sort of certain customers are impacting your margins, how certain choices need to be made up front to get a certain result further down the track. Really does rely on good reporting. So another critical piece of sort of having our CFO advisor improve the reporting is he has been very involved in helping the business connect the dots within the business. So as I said before, it's essentially a manufacturing business. There's a sales and marketing team that go out to sort of find customers and find new leads for sales. And then, of course, you've got the finance function. And the processes that we put in place allow the manufacturing team to talk to the sales team, to know what's coming through the pipeline, and then to feed that through into the finance function to help with forecasting and budgeting, so that we know what the situation looks like for the sort of 12 months and even sort of 18 months beyond the point where we're at now. And this has been extremely critical to know, I guess, where the gaps are in our production and where we need to fill it, which can help drive our sales approach. So as a result of this, we're now able to make very live business decisions in order to increase the earnings of the business. Another key thing we put in on the governance perspective is ESG reporting and also cyber reporting and various cyber initiatives that the business didn't have in place before, because it's just hadn't been a focus. But obviously, as we all know, cyber is becoming an increasingly important issue. And if there were to be some kind of hack, it could really be extremely disruptive to a business. So we've helped the business get those two pieces with ESG and cyber underway. Now, just moving on to the second point, which is on the people side. A key part of this deal is that the founder, Tim, wanted a clear succession path. Excuse me. And he recognised that his strengths were better used elsewhere in the business. And this involved mainly focusing on technology. He's a sort of an engineer by trade. He loves tinkering, and he loves the products that he makes and always wants to solve the problem. And that's what he's good at. And that is what he wanted to focus on for the next few years while he's involved in the business. This meant that we had to bring on a CEO to run the rest of the business. And we have done that extremely quickly, I have to say. We invested in the business in August, and we had a CEO ready to start in April. And as I'm sure you would have experienced, hiring at that level can take a number of months. Usually at that level, people can have sort of 3, even 6 month sort of gardening leave provisions as well in their existing employment contracts. So that was an extremely quick turnaround. This also has clearly helped with dealing with key man risk as Tim starts to impart his knowledge on the new CEO to sort of spread out that risk and to really help with the long-term succession plans of the business. Another key thing that we have done here is also recut management incentives to ensure that the management team are aligned with the shareholders in terms of that sort of the Tim and sort of ABGF's view on where we want to take the business going forward. So this includes both a long-term incentive plan, which includes management equity, as well as a short-term incentive plan, which can be tied to profitability of the business and individual KPIs. But the key thing is everyone is on the same page, which perhaps wasn't a model that was done before, and not a model that we generally see in a lot of sort of SME businesses. Now, the third point I wanted to discuss here is growth. Now, we have helped the business on growth on both the organic as well as the inorganic side. So on the inorganic side, I won't spend too long on this as we're in sort of early stages on this, but essentially we've helped the business explore various M&A opportunities that they probably would not have had the bandwidth to uncover previously. And then on the organic side, we have also been working with the business quite hard on this in the last sort of 6 months in particular, on ways to diversify revenue streams to increase revenue, and also to revise the wholesales and marketing strategy so that we can increase market penetration with the current products that we have. And that's something that we've started to put in place already, even though we're only just sort of 12 months into the investment. So as you can see, it's been a pretty busy 12 months, and the value creation activities definitely don't stop here. We sort of have a long list of other things that we are working on the business with, and and Tim and the team have been pretty wonderful in implementing these strategies along with our guidance. So I'll now hand over to Jack, who will cover CLS.
Thanks, Manpreet. So Consolidated Linen Service is an essential services business. What they do is they provide fresh linen for 700 customers across a big span of geography in central Queensland, ranging as far south as Noosa through the support of the Harvey Bay facility all the way up to Airlie Beach. The family behind Consolidated Linen Service is the Roberts family. So Neville and Marina, mum and dad, started the business. Adam, who's in the picture there on the bottom right-hand corner of the slide, is in his early 50s. He's the managing director of the business. And Adam's brother, Tom, is also in the business as well. And the family's built a wonderful connectivity to that community across all parts of that central regional Queensland area, with delivering that core essential service. They came to us because they wanted to grow. They wanted to open up a new plant in Rockhampton, which would be high efficiency, high automation. And we spent quite a lot of time with Adam, Tom, and the Roberts family and really got to better understand their business, where they wanted to go from a growth journey, and found it to be a compelling investment. We ultimately consummated that investment in June of 2024. I think it's been a really wonderful partnership with Adam and the Roberts family over the past now 13 months. And to kind of build upon my colleague Fred's comments from earlier, if we look at the bottom right-hand side of the slide where it talks about where there's been value creation support from ABGF, we really think about this as a set of pillars that ultimately are able to take advantage of that growth agility set of opportunities. And to circle back to Fred's comments, a big part of that is governance, a big part of that is management excellence. And through those two pillars, that is how a business is then subsequently able to take advantage of growth opportunities and being agile around how those opportunities arise and executing on them. And so by looking at those 4 bullets in the bottom right-hand corner, I think those last 2 bullets are a big part of that foundation of where we've been able to support Adam and the family. That 3rd bullet is around governance. We were able to secure a really wonderful chair who had a projects background, but also leadership experience, having been a CEO of 2 ASX-listed businesses and spent a number of years at Woodside Petroleum. So that really cemented a really wonderful board that's in place. And then secondly, we're able to secure a really credible financial controller into the Harvey Bay headquarters, who had previously been at a quite significant national engineering services business and brought a level of additional sophistication and capability to the finance function. That 4th bullet talks about the different other sort of, we'll call them core foundational elements that we've really helped with the business. And one of those key pieces that we really call out is the prioritization of workplace health and safety. I think the business had always had that as an element of what they did, ensuring that all the different hundreds of workers at their 4 different plants were being able to deliver the services safely and ensuring that people were treated in the right way. But we really have put elevation to the area, and we've seen the results of that even over the past 12 months in terms of less LTIs and having LTI-free months, which is a great sort of outcome to the business. And I think it really sets up as another element as to the foundational success of what a business is able to subsequently achieve. And so a lot of those pillar points were able to be established in a pretty short period of time post our investment. And so that has allowed us to achieve the first 2 bullet points. The second bullet point around debt financing, I think that's given us and the CLS team more funding certainty in being able to get the new Rockhampton plant up, which it should be done and operational by year end 2025. But the first bullet is the one that I think is being really sort of intriguing to see play out. And that scenario was a competitor to the business that unfortunately ran into their own financial difficulties, and they had 200 customers across central Queensland that, because they ran into difficulties themselves, were ultimately potentially left out to dry, with no commercial solution in a space that they needed an essential part of their sort of I guess linen being provided to them to run their hotels, motels, accommodation, mining camps, hospitals, and the like. And so we were able to work alongside of Adam and the Roberts family, as well as our chair, Jeff, to be able to ensure that a great number of these customers, I think ended up being 160 in totality, were able to be supported by Consolidated Linen Service through our various network of plants. And that is going to really support also underwriting the volume needs that we will need to be able to drive the efficiencies and the volume levels we want from the new Rockhampton plant. So that's been a really great outcome for Consolidated Linen Service. I think our value add there was really being able to navigate how to go about the execution of that transaction in a very thoughtful and considerate way, but also supplemented by the Roberts family desire to want to ensure that 160 odd customers were able to be provided an essential service of fresh linen to run their own SME businesses. So that I think sort of summarizes and talks a little bit about some of the levers that we've been able to support the Roberts family and the Consolidated Linen Service during our initial investment period. With that, I'll pass it back to Manpreet.
I'll send this on to Tim.
Pass it right out the back line. Thanks, Manpreet. So we'll turn to questions from the audience now. Thanks everyone for listening. So we have 5 minutes. So please, in the Q&A function of the chat or the chat function, I'll do my best to sort of oscillate between the two and answer any questions. Whilst you're submitting those questions, just to address a couple that have been asked, we will share our slides after this session, and on the final slide is my contact details. Please feel free to reach out if you have any investment opportunities that you'd like to discuss. Very happy to talk with companies that you may be connected with or companies themselves. So please feel free to contact me for that. I might kick off just with a question for myself. Anthony, I'll ask this question to you. Would you be able to just give a bit of broader context of the ABGF team? One of the key aspects, I guess, that's come out from sort of these slides is, how closely we work with companies. So I thought it might be good to give everyone a bit of a sense of the broader ABGF team.
Yeah, sure. Thanks, Tim. Well, the team at the moment is 30 people, and that's made up 2/3 of investment team members. That includes people like Manpreet and Jack and Fred, who you've heard from so far. I would say, and we're sort of split between 50-50 between Melbourne and Sydney, but obviously work with businesses around the country. I would say in terms of how we split our time, I would say that about 10 to 15% of the investment team's time is on what we call due diligence and structuring of investments. And then, somewhere between 85 and 90% of their time is spent with the founders, with the boards, with the management teams of the portfolio companies that we've invested in. So that probably gives you a sense of the weight of focus and effort that goes into, value creation and portfolio management. For anyone that runs a business, the market's tough. The opportunities to seize growth are always challenging, and often you've got economic challenges that are happening at the time. I mean, we've been supporting a number of our businesses over the last 6 months, really, with trying to navigate the sort of what we would call the Trump effect of tariffs and how that impacts for those that are selling into the US or into other countries, or suppliers that are coming in from other countries as well. So I think that the balance is on supporting the founders and working with the management teams and value creation, and most of and frankly, that's where all the value is in sort of realising the growth profile and lifting returns for those businesses.
Thanks, Anthony. Shelley, thanks a lot for your question around opportunities in Queensland. Actually, very timely. Anthony and myself were in Queensland last week, and we're very excited to see a number of mid-market businesses that are benefiting from some large infrastructure projects happening in Queensland. A number of sectors we think are quite attractive within Queensland at the moment. The Olympics coming in 2030 are an exciting space. So please reach out with any of those opportunities. I might next question to Fred. Thanks, Martin. Keen to dig into a little bit more around how we assist companies with succession planning. And I think one of the aspects around kind of being viewed as a first stage in taking some money off the table. Would you be able to provide a bit of context?
Yeah, sure. Well, that conversation starts very early with the founder pre our investment during the due diligence process, right? I mean, Moonpreet alluded to it in the case of Tim Madra. That was the very first conversation with Tim for about 2 hours was, what do you want to do with your life in the next 10 years? And that's what he said. I don't really enjoy being the CEO. I want to spend more time with the grandkids, and I love tinkering. And I can see just through this investment process that it's taking a lot of time being the CEO of a company about to become bigger. And that's how we agreed with him. Okay, let's talk about the organization. Let's talk about your son. How do we develop his son? How do we put a CEO in place? What was going to be Tim's role? So all of that was pretty much, kind of agreed upon with Tim before we even wrote the check. So that would be the, the answer to the question of confirming with the CEO. Some CEOs, it's very clear. It's the opposite, right? I want to be a CEO. I'm in charge. It's my business. I want to see it through exit. I'm giving myself 3 years to, double the value of the equity, and I'm ready to sell and move on to the next thing. So again, horses for courses. We tailor our approach to whatever the founder wants.
Thanks, Fred. And thanks to Chris around your question around early stage opportunities and pre-profitability businesses. More than happy to chat through sort of that aspect with you and kind of where we fit within the market post this session. Navneet, we've got a question, Jack. I'll direct this one to you. It's just around reaffirming sort of our, I guess, position on revenue and EBITDA size and kind of how we look at the size of the businesses that we're trying to invest in.
Yeah, so thanks for that question, Tim. I would echo Anthony and Tim's earlier comments. From a revenue range standpoint, we're generally looking at opportunities with businesses in that $10 to $100 million revenue range. As it relates to profitability, we are looking at businesses that have a track record of profitability. Ultimately, we need to make our check size work, which is $5 million at the low end, $15 million at the high end for initial check. And so that can often imply a certain type of earnings or EBITDA profile for us to retain a minority stake. And that floor can directionally be $2 million earnings, but it can fluctuate depending on the type of business model that we see.
Awesome. Thanks, Jack. And Ross, appreciate your 2 questions there. Firstly, I can take that one around for the broader audience. This is around our appetite around mining technologies that are improving processing productivity. Certainly an area of interest. We're having a number of discussions with companies at the moment in the broader sort of mining services space, and that are extending the life of mining equipment or improving production capacity of that equipment itself. So very interested in that space and look forward to talking with you about that post this. Similarly with your question with a business that you're offering an introduction to a CEO to, would love to speak with you and them post this session. Just scrolling.
You would be the key contact, right? I mean, Tim's details are at the end of the presentation. So if anyone wants to do any introduction, you can reach out directly to Tim or any one of us. Our emails are on our website.
Fantastic. And I think we have time for one more question. I will just scroll through How much pre-investment focus is there on alignment around expectations around the size of business and investment horizon and possible exit? So Jack, I might ask you to touch on sort of how we think about exit.
Yeah, 100%. So I piggyback of Fred's comments. I think initially there's a focus on alignment around what the founders and owners of the business want to do, and we want to make sure that there's clear alignment in terms of what they want to do and what we're signing up to and joining the journey. I think the size of business piece is really more of a mandate question, which I covered just a moment ago. And then as it relates to exit, I think there's two limbs that I would cover. So one is we do quite a lot of work as part of our due diligence prior to investment to understand all the exit pathways and options for a business. And that's a big part of our ability to be able to monetize the equity value that we're creating alongside of our founders and operators in our businesses. But where there is a distinct point of differentiation compared to other private capital firms out there is really the patience with which we can go about that. And as Tim mentioned earlier on in the webinar, we're more of a 4 to 7 year holder of businesses, potentially up to 10 years, versus a lot of private capital, private equity in Australia tends to run to more of a 3 year time frame. So that sort of optionality and patience around time of exit allows more opportunities and optionality to arise to optimize the equity value outcome for both us and the existing founders and owners of business.
Thanks a lot, Jack. Apologies, that's all the time we have for questions, but thank you very much for the thoughtful questions and for joining our webinar. We'll make sure to check through the list of any questions that we've missed and come back to you in writing post the session. As discussed, we'll share the slides post this webinar, and also please don't hesitate to reach out to me if you have any investment opportunities. If you'd like to follow more of our content going forward, please subscribe on our website and LinkedIn. And again, thank you very much for joining. Look forward to talking with a bunch of you post this webinar. Thanks.
Thank you.
Thanks, everyone.